لنا يا حبيبنا لك الشفاعة يا رسول الله يا نبي يا نبي يا نبي يا نبي يا نبي يا نبي يا رسول الله يا نبي يا نبي يا نبي يا نبي يا نبي يا نبي يا رسول الله. لدنا بك يا حبيب أنت للخلق يا طبيب اشفع لنا يا حبيبنا لك الشفاعة يا رسول الله. لدنا بك يا حبيب أنت للخلق يا طبيب اشفع لنا يا حبيبنا لك الشفاعة يا رسول الله يا رسول الله يا نبي لك الشفاعة وهذا مطلبي أنت المرتجى يوم زحامي اشفع لنا يا خير الأنام اشفع لنا يا حبيبنا لك الشفاعة يا رسول الله يا نبي يا نبي يا نبي يا نبي يا نبي يا نبي يا رسول الله يا نبي يا نبي يا نبي يا نبي يا نبي يا نبي يا رسول الله. جئت للبرايا بالشرع المبين تنشر الهداية بين العالمين اشفع لنا يا حبيبنا لك الشفاعة يا رسول الله. جئت للبرايا بالشرع المبين تنشر الهداية بين العالمين اشفع لنا يا حبيبنا لك الشفاعة يا رسول الله يا رسول الله يا نبي لك الشفاعة وهذا مطلبي أنت المرتجى يوم الزحام اشفع لنا يا خير الأنام اشفع لنا يا حبيبنا لك الشفاعة يا رسول الله يا نبي يا نبي يا نبي يا نبي يا نبي يا نبي يا رسول الله يا نبي يا نبي يا نبي يا نبي يا نبي يا نبي يا رسول الله. لدنا بك يا حبيب أنت للخلق يا طبيب اشفع لنا يا حبيبنا لك الشفاعة يا رسول الله. لدنا بك يا حبيب أنت للخلق يا طبيب اشفع لنا يا حبيبنا لك الشفاعة يا رسول الله يا رسول الله يا نبي لك الشفاعة وهذا مطلبي أنت المرتجى يوم الزحام اشفع لنا يا خير الأنام اشفع لنا يا حبيبنا لك الشفاعة يا رسول الله يا نبي يا نبي يا نبي يا نبي يا نبي يا نبي يا رسول الله يا نبي يا نبي يا نبي يا نبي يا نبي يا نبي يا رسول الله.
Assalamualaikum warahmatullahi wabarakatuh dan salam sejahtera. Mohon perhatian bagi memastikan majlis berjalan dengan lancar. Hadirin sekalian diingatkan agar memastikan mikrofon berada dalam pengatur jaraan senyap. Kerjasama daripada para hadirin amatlah dihargai. Pompam bergema, pusaka bangsa, dipalu oleh si anak muda. Hadir tuan, meriah suasana, kami menyambut penuh gembira. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera dan selamat petang. Selaut kasih seuntai rasa. Saya, nama stabiliti awam, bagi pihak urus setiap program webinar DIY Labur Saham di Bursa mengalu-alukan kehadiran para hadirin sekalian dan mengucapkan selamat datang. Alhamdulillah, bertemu lagi kita pada petang ini. Semoga perkongsian kali ini dapat memberi manfaat kepada semua. Tidak hadir sekalian, tanpa berlengah masa, majlis diteruskan lagi dengan slot pertama pada sesi petang ini. Slot ini akan disampaikan oleh Profesor Dr. Safwan bin Muhammad Noor selaku Ketua RIG Financial Market and Corporate Governance. Tajuk yang akan disampaikan oleh beliau adalah Technical Analysis. Sebelum itu, izinkan saya membaca sedikit biodata Profesor Dr. Safwan. Beliau banyak pengalaman industri dan profesionalnya merangkumi peranan sebagai pengarah dan perancang kewangan di syarikat kewangan yang dilesenkan oleh Bank Negara Malaysia dan Suruhanjaya Security Malaysia. Beliau merupakan peniaga berlesen di Bursa Malaysia dan pengurus lembaga Majlis Perancangan Kewangan Malaysia. Beliau juga dilantik sebagai penceramah di bengkel perancangan kewangan dan pelaburan syariah yang terkenal. Baiklah, majlis dengan segala hormatnya menjemput dan mempersilakan.
Assalamualaikum and good afternoon. Thanks, MC, for the introduction. Just a quick note. Actually, I'm not feeling quite well, so at times you might not hear my voice properly. But let me know if some of the things that I explain are not quite clear. Is it okay if I present my presentation in English?
It's okay, Doctor.
All
Can
right,
proceed.
thanks. Okay, let me share the slides first. Um, can you all see my slide?
Boleh, boleh.
Yes.
Okay, thanks. So yes, just like what the MC presented earlier, I actually came from the finance industry, several years of experience as a dealer myself, like our presenters earlier this morning. And then after that, I joined UMT, pursued my master's and PhD, and I got an offer to rejoin the finance industry, part-time that is, with the permission of UMT as a director and financial planner of a licensed financial company. So at the same time, I also have experience as a board member of the Malaysian Financial Planning Council. And at UMT, I also handle the endowment fund. If you are familiar with UMT endowment, including the Derma Siswa endowment. So I led that one as well. So in my professional careers, I have monitored, advised, and executed trading transactions in total, I think worth several hundred millions ringgit. But yeah, right now I'm a lecturer and researcher at UMT, and I'm also attached with the Victoria Institute of Strategic Economic Studies, Victoria University, Australia. So without further ado, I just pursue I would like to pursue this topic actually to continue with this topic on even though the proposed topic is only on technical analysis, it is undeniable that market efficiency is key as well. And I think most of the audience today are bachelor degree in economic students, right? So I'm sure most, if not all of you, are familiar with the concept of efficient market hypothesis. So market efficiency is on the other side of technical analysis. I mean, it's an opposite view. All right. So what happens is I cannot speak about technical analysis actually without talking about market efficiency. So what happens is what I'm going to do firstly, I'm going to briefly present on the efficient market hypothesis. And then in part two of my presentation, I will continue with technical analysis or behavioral finance. Keep in mind as well that behavioral finance on its own is considered as a field. At the same time, some of prominent researchers as well, actually, they use the term behavioral finance and technical analysis interchangeably. What it means is that you can also use BF, behavioral finance, there to refer to technical analysis. I'm sorry, just a sec. Okay. So just some brief background of market efficiency. Now, before I continue, how many of you have not heard of this term, market efficiency or efficient market hypothesis? We have lots of participants here, 119 now. So all of you have heard this concept, yeah? If Dr. Zai doesn't mind, can I choose one of the students here to briefly explain the concept? I just want to see how far you understand this concept.
Mungkin quite new to them like this concept because kita dalam kita punya konteks syllabus EMH is not really touch
I see.
ataupun
Okay.
tak really emphasize lah dalam kita punya syllabus.
I see. Okay.
Tapi mungkin some of them have heard about EMH. Yeah.
Okay. Okay. It's okay then. Thanks, Dr. Zai. Very quickly, yeah. According to Paul Samuelson, which is a Nobel Prize winner, he said that finance or financial economics is actually the crown jewel of social science. Obviously, in social science, you have many fields, right? Like marketing, accounting, and so on. Finance or financial economics is considered as the crown jewel. And according to Professor Lu from MIT, part of that really significant thing about finance is actually efficient market hypothesis. So this is a very, very key subject because what happens is everything, even in other fields such as accounting, for instance, most of the things when they do things such as value relevance or firm value, Tobin skew, and so on, most of the research actually um, consider or assume that the market is at least semi-strong efficient. So because of that, right, this is a very key topic. But this actually relates to my presentation today as well. So what is the role of capital markets? Efficient market means that it allocates funds to their most productive users. Okay, that is one way to look at it. But in terms of publicized price, the market prices that you see earlier, that you have the trading platform, you can see the market price, real-time prices of the securities traded in Bursa Malaysia. If the market is efficient, you believe that the price to be very close to its true or intrinsic value. So intrinsic value, there are many other terms that you can use to refer. Okay, true, intrinsic, fundamental, fair value. There are many things, many terms that you can use interchangeably as well. So earlier today, there was a presentation on fundamental analysis. So fundamental analysis is one of the ways, such as dividend discount model, free cash flow model, and so on, whether it is top down or bottom up, in order for you to find the true value of the security. So what does it mean by true value? For example, let's say Petronas Dagangan, I don't know the current stock price, but let's say Petronas Dagangan is currently trading at 15 ringgit. When you do some calculation, you know that the price actually should be 30 ringgit. Okay, just an example. So it means that the market is not really efficient, right? Let's say your calculation or your modeling is correct, that the market is not efficient because it is only selling at 15 ringgit, where the correct price should be 30 ringgit. Look at it another way. Let's say you want to buy a brand new Ferrari, right? And let's say I want to sell you a Ferrari, a brand new Ferrari, at only 50,000 ringgit. Do you think that is the correct price or not? Obviously, it's not, isn't it? Because you know that a brand new Ferrari should be selling at about, say, 2 million ringgit. So the market is not efficient in that particular example, all right? Or I'm not efficient, or maybe I'm not rational. That is another way to look at it. So advocates of behavioral finance, when you look into both finance and psychological perspective, argue that prices of not only equity but other securities as well can actually deviate, right? It doesn't have to be always the same or close to their true or intrinsic values. So Bursa Malaysia actually promote market efficiency. Why? Because if the price is not true, it doesn't reflect the fundamentals of the company, then people can first exploit the prices, and second is in terms of production or in terms of investment from the side of the company. If you look into the capital budgeting, then the cost of capital doesn't really reflect the prices. So this market efficiency can also allow for more informed investment decision, because you know that what you are paying for is the right price, isn't it? You don't want, for example, to buy an ice cream for 1,000 ringgit, isn't it? A simple ice cream like the Cornetto and so on, you don't want to buy it at 1,000 ringgit because you know it is not the true price. It's the same as securities as well. Whenever you want to invest in stocks or bonds and so on, the price should technically be close to its fair value. So very briefly, EMH is actually was developed by Professor Eugene Fama, which is widely considered as the father of modern finance, and he was awarded the Nobel Prize in Economics in 2013. What it means is that this is a theory which says that securities are actually in equilibrium and the prices fully reflect all available information, and they will react swiftly to new information. So let's say the company, you heard that the director just passed away or it involved in crime activities and so on. So the price of that particular stock should react quickly to that available information. I don't want to go into too much detail about this part, but this market efficiency can actually be presented as the following mathematical formula. One of the expected price or return, and then you're going to have the expectation operator as well as the set of relevant information depending on the uh, form, or because we're going to look into the three forms of efficient market hypothesis after this. So again, this is just a quick reference to what we discussed just now. Prices reflect all available information. So the price change is until expected returns are exactly commensurate with risk. This is another important factors in finance as well, where risk and return are needed to be explored and to look into together whenever you want to do an investment. So as a simple example, if I ask maybe I'm just going to ask one of the students here, one of the participants, let's say, Jessica Cannon. Jessica Cannon, can you hear me? And after this, Dr. Zai, lots of students will leave this presentation because they're afraid I will
Tak
call
apa,
out their names.
just call out their name. They get used to it, I think.
Okay.
Because yeah,
I think
that what
maybe
I
the
also do.
all right, maybe there's something wrong with the mic or because it's still muted. But what about Ju Hee? Ju Hee, can you hear me? So the students are not answering. Is it normal for the class? To be honest, in our class, it's normal like this as well. Like suddenly the students leave. I don't know why. Maybe they are afraid to answer the
Maybe
questions.
it's something new for them, like they're not familiar with the concept,
Yeah,
so not confident
it's
to
okay. Maybe
respond to you.
yeah. Maybe I'm gonna ask Dr. Jaharuddin because he looks very very smart there. Dr. Jaharuddin, and Dr. Jaharuddin is also not here. Maybe emergency. It's okay. All right. What I wanted to ask is a very simple question. You don't have to worry if you get this wrong. But let's say if I ask you to do a simple task, to just go for like a food panda, buy some food and then send it to a people's house, you're gonna expect to earn, let's say, 10 ringgit per trip. I don't know how much. I'll just making this up, all right? So let's say 10 ringgit per trip. But if I ask you to go to the river here, and we know that we have crocodiles here in the river, and if I ask you to swim in that river, how much do you expect me to pay you? Is it 10 ringgit? Is it cheaper than 10 ringgit? Or is it higher than 10 ringgit? So if you are rational, you know that it is very risky, right? In order for you to swim across the river, swarm with crocodiles. So because of that, if you are rational, yeah, you're gonna expect me to pay you much, much higher, isn't it? Instead of paying the same as 10 ringgit for people, just sending food via Food Panda. So that is the concept of risk and return. So basically in finance is very basic. Higher risk, you're going to expect higher return and vice versa. So again, prices at times can deviate from their true values and can adjust quickly as well. So what it means is that the trader cannot consistently, right? Consistently means that sometimes maybe they can by accident, by chance, but if the market is efficient, or the strong proponent of efficient market hypothesis will argue that you cannot consistently make abnormal returns after you deduct the transaction cost as well as considering the relevant risk for that particular investment. So in terms of information, earlier today, Dr. Zai also presented that information now is at your fingertips, isn't it? You can access everything using your mobile phone if you have some access to database and so on. So information gathering is motivated by desire for higher investment returns, isn't it? Otherwise, you will not bother looking for this information or do some mathematical modeling and analysis. You are doing that because you expect by doing so, you can earn higher returns. And the marginal return on research activity may be so small, and only managers of the largest portfolio will find them worth pursuing. Because why? You need one is perhaps the database, and you need the team. You need to spend some efforts and to pay the salaries and so on. If the market is fully efficient, you don't even need to bother doing this stuff, isn't it? Because what's the purpose? At the end of the day, prices already reflect all available information. So these are the three forms of efficient market hypothesis. Weak form is if you all the historical patterns and previous prices and volume data is already reflected in the price. So what happens is that even if you do some technical analysis, you are not expected to get uh, normal returns. Semi-strong form is you consider all publicly available information, which includes historical data as well as other publicly available information such as the fundamental data, corporate governance, SDG, ESG, environment, social and governance, CSR, those kind of stuff. Now, strong form efficiency means that prices also reflect private information, not only public. Yeah, private means something which is known only to insiders, such as a director of companies and so on. Okay, so this is highly unlikely, right? But most of the developed countries, the US, Australia, the UKs, for instance, they are normally considered semi-strong form efficient. Okay, so for developing or emerging markets, there are still some pockets of inefficiency where traders may be able to exploit, subject to maybe more advanced technical indicators or fundamental strategies. So this is just a summary. You can see it graphically that the weak form means all prices and returns and volume data as well. Yeah, not only prices. Public available information is again fundamental information, macroeconomic indicators, industry indicators, and ESG, SDG, and so on. While strong form also includes private, which is insider information. Right. So in terms of under or overreaction, this is important point as well that I want to highlight is very quickly. Yeah, if the market is efficient, again, by now I hope you understand the concept that the price react swiftly and quickly to changes or information. So you can see that when the any information is announced, let's say this is a good news, yeah, the company is making profit. So quickly the price will go up because the market is efficient, isn't it? But if it is delayed response, it means that the market is not really efficient. Then you can see this one, yeah. It takes some time for investors to react. So what it means is that if there is a slow reaction, you can gain some profit if you can exploit it sooner, because you know that it will reach this part, and then you already know that it should be this because you are among those efficient ones, all right, or you are the advanced and knowledgeable ones. You know that it will reach this point, yeah, this price level, but stock price reacts slowly here. So maybe you bought it here, for instance, yeah, you bought it here and you can still make profit. But if the market is efficient, then you can't, isn't it? Because immediately here it's already reaching this stock price, you can no longer make any abnormal profit. Overreaction means that people tend to think that, oh, this is a very good news, but it shouldn't be this level. And then slowly the price will go to its real or intrinsic price or value. Okay. So this is just a response to bad news. It's just the other way around. So far, do you have any question about this? All right, no question then. So what is the implication now? This part is important. Earlier today, we have gone through the presentation about fundamental analysis, about how information are widely available, isn't it? The CIMB also provided all these reports and so on. So if the market is efficient, if the investors can use all this information to process and then decide when and where to invest, then what would happen? Do you think you can still make profits or abnormal returns from that investment? Now, new information is unpredictable, isn't it? You cannot expect that the company will suddenly issue their statement saying that they're making lots of profit, unless, of course, if you have insider information. So because of that, right, stock prices actually follow a random walk. Now, if the market is efficient and the price fully and fairly priced, what it means is that you, as an investor, should not really waste your time to look for mispriced securities, which is fundamental analysis, and you should not also waste your time to do market timing, which is technical analysis, because what's the purpose, isn't it? The price is already correct. So what it means, fundamental and technical analysis are deemed useless, and then the best investment strategy whenever the market is deemed as efficient would be to simply diversify your investment. Surely you have heard of the idiom that you shouldn't put all your eggs in one basket, isn't it? You should properly diversify in order to reach the best risk return trade-off. Okay. So the investment implications again is that expensive strategy for active might be suitable only for very large portfolios, and fundamental and technical analysis is actually useless. And then you can, in this particular case, actually accept EMH, and then you should invest in index funds or exchange traded funds, which is a low cost investment. And of course, you can do portfolio management or portfolio diversification strategy or portfolio optimization in order for you to get the appropriate return for a given level of risk, or the lowest risk for a given level of return. Okay. So we're going to take a quick, I think, if it is okay with you, Dr. Zai and MC, maybe 5 minutes break. And then we're going to continue with the main topic, which is behavioral finance and technical analysis.
Doktor boleh.
Okay, thank you. In the meantime, it might be good as well if you want to go through some of the materials online, or some charts and so on, if you are interested to do so. Okay, just a quick 5 minutes break. I have to rest my voice actually. Okay, thank you.
Okay. Dr. Safwan dia tak berapa sihat tu sebenarnya. Tapi thank you Dr. Safwan. Walaupun dia tak berapa sihat, dia masih lagi dia spend some time untuk explain dia punya part tu mungkin saya boleh tunjuk sedikit lah kot berdasarkan Dr. Safwan punya penerangan ini yang macam mana kita kata efficient market hypothesis tu, adakah masih apply ke dalam tempoh sekarang ini, ya. Kita boleh tengok reaction daripada recently ada announcement of quarterly reports kan. Maksudnya company start announce dia punya earnings, sama ada mereka buat keuntungan ataupun tidak. Kita boleh tengok sikit. Ini saya prefer untuk pergi ke Malaysia Stock Base lah. Kita boleh lihat contoh dekat home ini. So ini latest announcement by companies in Malaysia. So quarterly earnings kita boleh pick mana company yang buat in past week, yang buat untung yang kau tinggi, yang ada star tu. Macam mana market react dengan good news bila dia buat untung yang luar biasa belakang sikit. Ni CIMB. Tu dia. Sebaik orang CIMB tak ada kat sini. Tak apalah, good earnings
Share slide ke doktor?
Oh sorry, saya lupa nak share, sorry.
Okey doktor.
Sementara Dr. Safwan tengah rest kejap tu kan. Ni. Okey. Kita buka WhatsApp pula. Okey. Saya boleh nampak dekat sini. Ini quarter report dia keluar kat sini. Q maksud dia quarterly report keluar kat sini. So, you nampak apa jadi kan, dia react juga, market react, tapi saya rasa quite strong lah kat sini reaction untuk CIMB punya report. Tapi kat sini bila dia every time dia announce report akan ada reaction walaupun ini red kan. So ini dia buat green, memang untung. Dia kata untung lebih daripada biasa. Bila ada star ni maksud dia buat untung luar biasa lah ni. Ada double star kat sini, maksudnya profit dia pun meningkat dengan kadar yang dramatik. Begitu juga dengan revenue dia. Boleh nampak ada star kat sini. So this is a signal of, this is actually a good signal to the market bila ada star macam ni. 1043% dia buat keuntungan CIMB ya. So market react. Market react, as you can see dekat chart ni. Dia problem ni sebab dia banyak iklan kat sini. Okay, nampak tak? So misalnya daripada dekat sini kan, punya price and then market react dan harga dia naik. So itu contoh lah nak tunjuk macam mana market dia incorporates the information, dia react. Okay, with public information sebab corporate announcement like quarterly report, annual report ataupun news adalah publicly available information. Sebab tu saya kata semua dekat ujung jari je sekarang ni kan. You buka je CIMB, klik je mana-mana company, terus nampak. Tapi ni tak syariah ya. Terus nampak dia punya news dan sebagainya, latest announcement dia, latest headline. So maksud dia, ini semua adalah maklumat-maklumat yang penting yang ada pemberatnya. Okay? Ada pemberat untuk pasaran lah. So investors, sebab tu bila you jadi investors, you jadi traders, you akan ada habit untuk check news. So, almost every day. I do that almost every day lah, especially before going to bed. I will maksudnya open my KL screener apps tu, so saya akan scroll down tengok news. Maksudnya saya nak tengok apa peluang yang saya boleh ambil esok tu. Okay, so you will have this habit if you start trading. Sebab apa? Bila you put some capital in certain stocks, you want to make sure that you manage the risk kan. You tak nak lah biar, sebab you tak nak lah biar maksudnya modal you hangus. So you kena berhati-hatilah kalau ada news yang tak baik ataupun kalau ada good news, you can take opportunity out of that. Maksudnya kata sentiment lah. Sebab sentiment leads into market. Sentiment leads to market. I think that's it lah for now.
Thank you, Dr. Zai. Dr. Zai actually can just continue with the presentation for this topic as well.
Tak apa, sambung lah teori dulu.
Okay, thanks, Dr. Zai. By the way, it's interesting as well, the one that you showed earlier, and there's a question there if I can help answer as well. Kalau tengah naik macam tu, one of the comments there in the chat box, kita invest elok ke, tapi bukan time tu harga tengah tinggi sebab dia naik. So what happens is, this is why you need knowledge of both fundamental and technical. For me personally, I don't think it is wise if a person only look at fundamental or technical analysis. They should be looking at both. Yeah. So in this particular case, whether it is good or not, first you have to identify what is the intrinsic value, or what is the fair price of that particular stock given the information that was disclosed. So for example, if you do some analysis and then you find that the price is currently going up, but it is, let's say, at 30 ringgit, but the price that most expect will be around 40 ringgit, so you know that even though it's still you still have some buffer that you can make profit out of it from. Same time, you also have to look into some technical indicators as well, because you want to see how the trend is going. Because maybe one day it will reach that 40 ringgit price, but in the short term, maybe you might be losing some money as well, and you don't have the time or sufficient fund in order for you to get exposed to that potential risk. Okay, there are many things that you have to consider whenever you do this. That is just one of the things. So if I can just continue with the presentation, yeah, Dr. Zai?
Sure.
Okay, now the reason why I explain about market efficiency is, again, if the market is efficient, then what we are doing so far today, like the presentations just now on fundamental analysis, what I'm doing right now on technical, as well as the one that Dr. Zai presented just now as well, it is not really useful, isn't it? If the market is fully efficient. But you can see at the chart that Dr. Zai shared earlier, it's not quickly, isn't it? The price doesn't move quickly to that level. So you can see there's a slow trend. Can infer that the price or the market in Malaysia is not really fully efficient. There are still out of inefficiency that you can find. A very quick history of technical analysis before I continue with the indicators being used and the normal indicators being used in practice. So technical analysis is actually not new. All right. So it actually began being used by ancient societies long ago, when they used these past prices in order to forecast future returns. So in short, basic forms of technical analysis was already being used by ancient civilizations almost 3 millennia ago. In the 7th century BC, there you can see ancient Babylonians. I think you have heard of Babylons, yeah? Ancient Babylonians already used technical analysis, the basic form of technical analysis, in order to forecast commodity prices. So after that, throughout the ages, technical approach has been used by the Western worlds, including the Greeks and Romans, and then they moved to the Middle Ages and the Renaissance, and then after that to the Asian countries. So I think some of you have already familiar with this candlestick. So candlestick was actually developed in the 18th century by Munehisa Homa, which is actually a Japanese rice trader. So these candlestick charts are still being used right now, isn't it? You have the open, high, low, and then you have the, lots of combinations of using these chart patterns, like the moon, the doji, and so on, right? And then in 1834, Charles Dow developed the Dow theory, which is the average. Now, this is actually the origin of the Dow Jones Industrial Average, which is the 30 largest stocks in the US market. So, in Malaysia, we have the FTSE Bursa Malaysia KLCI, the largest 30 stocks in Malaysia. Earlier, the CIMB presenter already said that Mr. DIY is now will be the constituent, one of the constituents of the KLCI. So the Dow Jones started from this Charles Dow, who developed this average. And then in Australia, we have the ASX, for instance, ASX 200. New Zealand, you have the NZX 50 and so on. Okay. In the 20th century, then you can see lots of development of many modern indicators, such as the moving average, simple or exponential, the moving average, convergence, divergence, relative strength index, average true range, Bollinger Bands, etc. Why? Because during this time we are lucky to have this modern PC, as well as lots of applications that most people have, such as Excel, isn't it? Now, starting from the early 21st century, you have more and more advanced and sophisticated software available that you can use, as well as programming language such as C Sharp, Python, R, and software such as MATLAB and so on, isn't it? And then, of course, another big development is AI, artificial intelligence, as well as big data. So this actually also being used in order for you to formulate the technical indicators and to forecast prices of relevant securities. So what is technical analysis actually? It is basically the study of past market behavior to determine the current state or condition of the market. So technicians actually believe that any price influencing factors, whatever factors that influence price, such as fundamental, psychological, etc., it's actually already reflected in that particular stock price. So because of that, since they assume that all of the factors are already reflected in price, a pure technician doesn't really look into fundamentals. Why? Because the fundamentals are already reflected in price. So the only requisite is just they want to study the market itself, which is the price and the price patterns and the formulation, rather than looking into the annual reports and so on. So what are the principles of technical analysis? The first one is prices move in trends, obviously, isn't it? Even if you see the small chart there, if the price doesn't move in trend, then what's the purpose of technical analysis, isn't it? You expect that there are some trend that can price movements that you can then make some prediction and make money from it. The market discounts everything. It means that whatever information, fundamental, economics, psychological, is already reflected in the price. And another thing, the important thing is history tends to repeat itself. That is why you have what you call the chart patterns, isn't it? If it doesn't repeat itself, you don't have the patterns. So because of this history that keeps on repeating itself, then you can look into these familiar patterns in order for you to use and find whether you should buy or sell the stock given this particular pattern. So a quick bit. Prices is basically a function of demand and supply, isn't it? It is solely the interaction of demand and supply that actually set the prices of stocks. So supply and demand are actually governed by numerous factors, both rational and irrational. And the market continually and automatically weights all these factors. Let me use this pointer. Okay. So if you disregard minor fluctuations in the market, stock price actually tend to move in trends, which actually persist for a certain length of time. That is why you call it trends. And this is actually relevant for pattern formation. And these changes in trend are actually caused by shifts in demand and supply. So these shifts, no matter why they occur, because again, you remember, one of the consideration or assumption of technicians is that prices discount everything, can actually be detected sooner or later in the action of the market itself. So if you look into technical analysis and behavioral finance versus fundamental analysis, is it versus? It is not actually versus, yeah. Technicians actually do not deny that fundamentalists can find the intrinsic value of stocks. But what happens is they believe that if you look into the fundamental itself, it is very slow to determine that particular value of stocks. That is why normally if you look into fundamental analysis, you are actually investing in the long term, isn't it? So technical analysis is more towards the short-term investment rather than the long-term ones. Now, first one is subjective. This one, subjective interpretation. I myself, actually, if you ask me, even though I come from the industry before and I still do research in this area, I don't really like subjective analysis. In fact, if you want to publish papers, research paper, that is journal articles, if you are using subjective analysis, it is very, very tough. And not many papers, especially in good journals, are published focusing on subjective analysis because it is subjective. And this is different to objective analysis, where you actually use some mathematical equations, and this allow you do the proper analysis and you can validate it as well. So stark difference between subjective and objective analysis there. So in terms of technical indicators, obviously this is, I think, why you come here. There are actually hundreds or perhaps thousands of chart patterns, and technical indicators that actually investors claim work. So these are the very basic, simple moving average, and the formula is very simple as well. You have the moving average convergence, divergence, relative strength index, and average true range. Now, these are the basic ones, but they are still very popular and being used widely by investors in Malaysia as well. Yeah, in one of my Telegram groups, I have lots of active investors. Yeah, they are actually part of the team with, I don't remember, the like Nazri Khans and two or three very prominent technicians in Malaysia. Yeah, and earlier, Dr. Zai also explained how not only you can make money, 10% per annum, but also in a few days. That is true, actually. In my group, some of my friends actually they can earn 7-8% in just 1 or 2 days. But they can also lose money. Yeah, that is why some risk management strategy is also important, which I will show after this as well. Keep in mind as well, yeah, if you are guaranteed to make money, it is no longer Sharia compliant. Because investment in Islam, yeah, you should be exposed to both risk and return. If it is guaranteed, if the return is guaranteed, even the Sharia Advisory Council will not approve it as a Sharia compliant investment. So you have to keep that in mind first. So what you can do is you can minimize your loss. Okay, you cannot guarantee that you will earn profit, but you can minimize your loss by having some risk management strategy. Anyway, about moving average, this is the most popular one. You have the average price of a given interval, and then you have this particular window is updated over time. I'm going to show you after this. Yeah, you don't have to worry. These sentences are not quite clear, but once you see the example after this, it's much clearer. And then again, you want to identify underlying price trend. And then some examples of the moving averages are these ones, yeah, the simple ones. And then you have the exponential moving average, where you have the more recent data, you assign more weight, and the weight is actually exponential. Yeah, that is why it's called exponentially weighted average in terms of the weight. You can have multiple moving average at the same time. So you can have double moving average, double simple moving average, double exponential moving average, triple, and so on. So the very basic signal is you want to buy the particular stock when the price actually rises above its moving average, and you want to sell if it goes below that moving average. So this is a very quick example where how do I, yeah, okay, expand panel to show, all right, okay. So you can see this very quick example about Intel Corporation. You can see the price, open, high, low, close, and as well as the volume, and then you plot the 50-day moving average, and what happens if it goes, the simple indicator here, simple signal, you want to buy when the price rises above, okay, and you want to sell when it goes below. So the price is the blue line here, okay. So you can see that when it goes below the moving average, it continues going down, isn't it? And then of course there are some fluctuations there, but of course you're going to expect that the trend for this particular example is it goes down. And then what happens when it goes or it crosses above this particular moving average, then you can see the okay. So this is the most basic one. I don't expect students, okay, especially you guys as well, don't put high expectation that after this, if you use this particular formula, surely you're going to become multi-millionaires. It's very simple. No, because this one is a very, very basic one. Okay, having said that, lots of traders in Malaysia, they actually use a very simple formula as well. And it works actually most of the time. Why? Because it's the market is again this price, it's just a forces of supply and demand. Someone wants to sell, someone wants to buy, and then it hits there, you're gonna transact that particular stock price. So because many people are using the simple formula, so basically it works, but only to a certain extent. Again, keep in mind that you shouldn't expect you're going to become a very wealthy or multimillionaire just by using this particular formula. This is just another example. If you look into the Dow Jones Industrial Average, and then you compare it with a particular moving average. All right. Now, this stock is actually called DIY, isn't it? DIY stock investing. So technically, I should also show you how you want to do it yourself, right? So this is the simple Excel example, yeah. In this particular case, it is actually a monthly data, and then you have the price. Let's say this is a monthly stock price. How do you use this particular moving average? And by now, I think you are familiar with this, yeah? So 3-month moving average, you can use either formula, it's fine by using Excel. Okay, this part here, and then this will be the moving average. Okay, and then this is the same. Okay, you can use this syntax from Excel, which will give you the same thing. So what it means moving average is because the let me erase first. Okay, because this particular next one it moves, yeah. This one refers to this part because it's a three-month moving average, isn't it? And this part, for example, yeah, would refer to this average of the 3-month prices. So whenever you want to consider the particular signal and the transaction, you should actually look into the buying or selling at the next period, which is what you call the T+1. And if you consider this as T naught, this one will be T+1. I'm sure you as economics degree students are familiar with this notation, isn't it? The naught and one subscript there. Okay, very basic one. If you have any question, please let me know, yeah? So the next one is moving average convergence divergence. This one is actually a trend following momentum indicator that shows the relationship between two moving averages of prices. Okay, two moving averages of prices, or specifically the exponential moving average. What it means is just it is a difference between this 26-day and 12-day exponential moving average. And then you also plot a 9-day EMA, which you call the signal line. So the developer of this, Gerald Apple, actually specifies this in terms of percentages, where the three moving averages can be described as 7.5, 15, and 20%, respectively. So what it means is that this particular moving average, in terms of practical applications, it is actually most effective in wide swinging trading markets. And the three most popular ways for you to use this